All right, what is up, guys? Good morning, good afternoon, good evening, and good night. I'm not sure what time it is by you, whatever time you're watching this via recording or maybe on YouTube. I'm not quite sure, but welcome. What I want to do today is discuss 10 pips. 10 pips. That's what I want to discuss. All right. The power behind 10 pips. I don't think we understand how pips really work, right? I don't think we understand the power behind not doing much and the market not moving much. I don't think we understand how we can use, you understand? How we can use simply just a very, very minute move within the market, right? And take advantage of it. And there are things that, I think people need to hear this, or people need to see this. Now, I know people oftentimes they always want this. B, what's the secret, boy? What's the secret? Why are you always at the right place at the right time? Why you almost always look like you get the trade right? Why it is B's a monster. Why is he always right? Or why does he get it so good? Or why? The answer is actually not what you think. I don't always get it right. I'm not always in the right place at the right time. I do get it wrong. I do lose, right? I do make mistakes. I've been wrong before and I'll be wrong again. Let me tell you the advantage of 10 pips. And I'm not just talking about 10 pips in regards to your stop loss, 10 pips broad spectrum, both positive and negative, meaning 10 pips profit and 10 pips loss, right? Why it's so important, or why it's so powerful, why it's so potent. If you are using proper risk management with the regards that you're making sure they're using the correct lot size for your account size, then this is a very potent system, right? 10 pips, if you're risking 1%, is actually nothing. Or to basically use 10 pips to make it so that you risk 1%, it's very potent. You get it wrong, you lose how much? How much do you lose? You lose 1%. You get it right, if price goes the same 10 pips, but instead of against you, it goes in your favor, how much do you get? How much do you gain? The same 10, the same 1%. Not so? You gain the same 1%. What about if it moves 20 pips? It's just 10 pips by 2. How much do you gain? You gain 2%. What about if it goes 40 pips in your favor? You gain the same 10 pips, which is the same 1%, just by 4. You gain 4%, and so on and so on and so on. But in this regard, all I'm doing, I'm going to be showing you 10 pips up, 10 pips down, meaning you gain 10 pips, you lose 10 pips, right? What if you could have taken a trade, one trade every single day, and all you had to do was capitalize on the direction of the market so that you can gain your 10 pip move, right? Capture your 10 pip move, capture your 1%, and then don't do nothing for the rest of the day. How do you think that sounds? Sounds like a dream job. Essentially, you work for God alone knows how many minutes for the day and you're done, right? You see, that 1% obviously is your 1% risk, right? Obviously, you need to have a good account size for this to happen. But let's be completely honest. 1% of $10,000 is how much? How much is 1% of $10,000? How much? 1% of $10,000 is how much? Very good. $100. $100 a day. Think about what I'm telling you, right? Think about what I'm telling you. $100 a day. 1% of 10,000, right? You get $100 a day, and you do this for 20 days for the week. I mean, for the month, sorry, 20 days. That's essentially $2,000 for working for a few minutes a day, because all you need is 10 pips. All you need is 10 pips. You're essentially making $2,000 a day, the equivalent in my country's currency, right, to about $13,000 in 20 days by working for nothing. You do nothing. All you do these exact same thing that I always do. You discern the direction and you look for your entry based on that concept. That's it. Let's figure it out. Let's see. So last night I said, right, as the market opened, today is Monday, the 21st of June. Wow, I don't know how it's the 21st of June already, but wow, right? I said that based on the previous momentum of Euro USD, right, that there's some possibility for sells on Euro USD. Did I not? Did I not say that to y'all in the group? Did I not say that? Yes? No? What y'all think? Yes? No? Good. And it's actually very simple. Here you have what you might call a double whammy, because the entry rules for this trade will near perfect, because on the 15-minute time frame, right, we already discern that the direction is down. We already know that the momentum is down, right? On the 15-minute time frame, you're gonna see here that if you followed me for a few years, you'd know that I have specific rules or specific rule set that I want to see price do something called a push, a pullback, and accumulate before I consider entering, before I consider buying or selling or whatever. This is where I usually typically try to enter. The reason being, price has pushed off in the intended direction, it has pulled back, and I'm not just waiting to enter on the pullback, I am waiting to enter on the accumulation, because the accumulation says to me that it's actually having problems continuing up, right? Isn't this move here, isn't this the same as this? Push, pullback, and accumulation. What y'all think? What do y'all think? Yes or no? Looks the same to me. So that is one. So look at the confluences here. Look at the confluences here. On the 50-minute time frame, this is what you like. You want to see this. But what if you didn't trust that? What if you suffer with uh, one of your psychological fears, or the psychological things that the enemies of your mind, your subconscious, that make you, they force you to not be able to act, right? This fear is called fogey, right? You know about FOMO. There's a fear called fogey. I'm not sure if anybody else has ever spoken about this, but I have spoken about this multiple times. Fogey, which is the fear of getting in, FOGI, fogey. You've been battered, you've lost so many trades that you're genuinely afraid of taking another trade, because you feel like you don't have enough information to base your trade off of. There's a very simple way to combat fogey, by the way, and it is with experience, right? With experience, you gain confidence, and then more or less anything, right? But we're not going to go into the solution to fogey now. What if you needed just a little more confluence to get in right here? Well, all right, let's go on the 1 minute time frame. So remember, we had this drawn. So you have something that looks like this, right? And listen, all of this is documented. I literally spoke about all of this last night, right? So you have your bear momentum here. It pulls back, and the very next thing, the literal very next thing you're waiting on is your moving average cross, right? Obviously, I've been basically, I don't want to say famous, but I've been known to create a system called the ECR, which is the exponential moving average cross and retest system, right? Basically, it uses shifts in momentum, right, to validate that the moving averages, yes, this cross is valid. The momentum has caused this cross to be valid, right? The best potential ECR or the best potential cross would be after an M or a W. I say this all the time. What about this? You have a little trend here. Maybe if you wanted to, you can consider this a very small M here. And again, I said this. This is on the record. I'm going to screenshot it and put it. This was happening real time. Real time. This is not me doing some back testing and, you know, I'm not acting on this. This is me genuinely acting on this information, right? And then after your M, you have your first cross, which is right here. Remember, the best potential ECR or the best potential cross happens after an M or a W, after a reversal. This is not any reversal by any grand gesture, but it is a shift in momentum. So you have your shift in momentum. Kind of uncanny that the shift in momentum happened around the area where the cross happened. But then look at what happened. You have on the higher time frame, this would be classified as your accumulation, and then price pushes down and pulls back. If you wanted to, you could literally have sold on any black candle that still respects your moving averages right here, up here. You have your 10 pip stop loss, which should be extremely, extremely safe, right? This is your 10 pip stop loss. This is the equivalent to you risking how much percent? With proper risk management, this is the equivalent to you risking 1%. Very good. This is the equivalent to you risking 1%. And all you need is for price to go 10 pips in your favor, and automatically you are up 1%. If you wanted to, as price touch right here, you close. If you wanted to, you could even use a take profit. I don't recommend it, but you could even use a take profit, close. You close the trade. 1%. You risk your 1% and you get your 1%. So in this case, because of how precise your entry and your entry style, your entry technique, everything was, right? You risk your 1%, you get your 1%. You're done. You're done for the day. If you wanted to, you come back the next day, you do the same thing again. Discern the direction, look at your entry rules. If you wanted to, you use different time frames to kind of confirm your bias that you have, and then you do that and you just rinse and repeat. But if you notice, your USD did not stop at 1%, it went 2%. So if you wanted to, and you say, well, all right, well, it's still going, you trail your stop loss as it keeps going, you put your stop loss around the 1% mark right here. So your stop loss, you put it right somewhere in this general vicinity. Boom. Right, as it goes. And it keeps going and it goes 2%. And if you wanted to, you close at your 2%. This is now effectively a 1 to 2 risk to reward ratio, because you risk 1%, but you gain 2%. But we're not talking about that. So let's just say you close it at 1%. You rinse and you repeat. Rinse and repeat. Look at what it looks like. Look at what that looks like on the 50-minute time frame. Look at your entry. Same rules. Push, pull back, accumulation. You enter as high in the accumulative range as possible. You get your 10%, your 1%, sorry, your 10 pips, and you run away. You run away. That's it. You risk 1%, you gain 1%. Come back tomorrow. Do this again tomorrow. People always say, well, you know, I've seen that people say that risking 1% is too much. So how much do you want to risk? How much do you want to risk? Listen, I cannot think of a safer way to trade, right? Obviously, it will take some time to be able to master. It will take some time to be able to understand and grasp and put into action. But this is literally the safest way I know to trade. It prevents over trading because you're only trading once a day. You can't overtrade when you're only trading once. You're risking only 1%, and you only stand to gain 1%. So there are not many moving parts in the system. This is a scalp, so you're not going to be in the market very long. Therefore, your emotions aren't going to be caught up in the market for very long. You're in and you're out. That is it. You go about your business, you go about your day, and you make your $100 today. You come back tomorrow. Obviously, if you have a small account, make your $10, you make your $1, whatever, right? But let's just say you have a $10,000 account, which is completely doable, right? By today's standards, not based on COVID, but by today's standards, if it is, you had a lot of savings that you wanted to invest, which a lot of people do all the time. I've seen people put $50,000 into a trading account and have no idea what to do with it. If you had $50,000 in your trading account, it'll be $500 a day, because that's 1% of 50,000. You're making $500 a day, right? For 20 days, assuming that there are 20 working days in the month, right? 21 working days in the month. $500 by 20, that's $10,000 a month you're basically making. In 1 month, you would have made 20% of that same 50,000 that you have, just by basically making 1% a day for about 20 days. They say that the power of anything is in the numbers. Women lie, men lie, children lie, the numbers don't lie. You risk 1%, my friends, you golden. Brian asks, if you lost, should you look for another setup or wait a next day? That's a very good question. And the answer is you wait a next day. Because the goal of this system is to literally take one trade a day. You win, you win. You lose, you lose. Next. You see, what this does is it not only, keeps you on course, but it gives you discipline, right? You said that you want 1% a day. You see, if it is you lose, right, and you lose your 1% a day, all right, fine, obviously, you're going to be down 1%. But if you go that same day and take another trade, it might be considered revenge trading. It might be considered revenge trading. And before you know it, that 1% that you lost could be 10% that you lost, because you just keep taking more trades. Coming back another day is essentially putting your tail between your leg and saying, you know what, I'll return tomorrow. You know what, I'm afraid of losing an next trade today. All right, so I won't take an next trade today. So I'll come back tomorrow to see if I can find something better. Maybe the market just doesn't want to give me something today. Obviously, you're not gonna. It's impossible. It's physically impossible to make, to just win. You're gonna have losses. But the beautiful thing is, when you're losing, you are only losing 1%. You're only losing 1%. That is the power of this, right? So if, obviously for me, the system that I use, I typically don't, risk 1% to only make 1% back. But this is a safe way to, to actually be a trader and to be in the market and to gain physical experience within the market, right? But for me, obviously, I'm going to try to hold for as long as I can, right? Or capitalize on as many pips as I can. Thus, me trying to capture not only 10 pips, but 20. Right, at least it's worth my while to to risk 10 but capture 20. That's worth it for me. That's a 1 to 2. Right, but this, what we're speaking about here, is literally just to be able to capture 1%. You risk 1%, maybe it loses today, come back tomorrow. That's absolutely fine. Don't try to revenge trade or wait a few hours. Come back tomorrow. Right? Now, now we get to the interesting stuff. Let's go back on the 1 minute time frame. All right. And we're going back to right here. Obviously, this is no longer, what I'm going to show you is no longer the equivalent of risking 1%, right? It's not the equivalent of risking 1%, because for every new position that you risk at 1%, it adds up. So if you open 5 positions, it's now you're risking 5%, right? Unless you decide to split up your percentage risk amongst each of those 5 positions. So the first position will be 0.2%. The next one will be 0.2, 0.2, 0.2, 0.2, all adding up to 1%. And while you can do that, personally, it doesn't make sense to me. If that is the case, just make one position. But if for some reason you feel like the market, you have a really good feeling that the market is going to go in your favor, right? And you wanted to capitalize on that, and you only feel like it's going to go 10 pips, you can still capitalize on that 10 pips and turn that 10 pips into 30 pips, 40 pips, 50 pips. The market only went 10 pips, but you can make it in your trading history that you made about 50 pips by opening more positions at the same 1% risk. So 3 positions at 1% risk is 3% risk. If the market goes 10 pips in your favor, you're risking 10 pips. You're risking 10 pips by 3 positions, which is 3%. But if the market goes 10 pips in your favor, it goes 1% in your favor by 3 positions, which is 3%. So you could effectively multiply how much, percent gain or risk, obviously. So don't feel like because, you stand to gain more that you'll still lose in the same 1%. No, you're going to be increasing your risk. But what I'm showing you is you can use extremely small moves in the market, just literally just this. You can use just something like that and make that, work for you. Just that, and make that work for you. So effectively, something like this, let's just say it goes 20 pips in your favor by say 6 positions. It'll be 2% gain by 6 positions, which is 12% gain. Right? So you risk 6% here because obviously you have 6 positions risking 1%, which is 6%. And it goes 2% in your favor because it goes 20 pips, by 6 positions, which is 12%. And I know this might be confusing to some people. It might. I know it might be a little confusing to people because people don't look and consider the percent risk. Most people consider is enter, snipe trade, that is it. But these are the things that you need to be able to at least understand or have a good understanding of by virtue of, the numbers, right? And the money aspect of trading, right? So that's that. You can actually scalp and still make a lot of money, albeit you'll be increasing your risk, right? And now the last thing I want to talk about is, again, using your ECR and how dangerously effective the ECR is. As the only thing I want to talk about for the rest of the morning. So as you may know, as I said, the ECR, best potential ECR, is after your M or your W pattern, right? After your M or your W pattern. How do you draw an M pattern or a W pattern? The first and most important thing in drawing your M pattern, the M pattern or the W pattern, essentially is a reversal pattern. The first and most important thing before you even begin to try to draw an M or a W or anything, you have to figure out or discern, is there a trend before the creation of the M or the W? If there's no trend, it does not matter, because then at that point, how do you know if the W is prevalent or not, if it's real or not? The trend confirms to you that the W is real, because the purpose of the W or the purpose of the M pattern is designed to reverse against the people who are, captured or trapped in the trend. And let me show you, right? So we have a trend here. We have a little channel here, right? And everyone can see this, right? Just ignore these little cells here that I had, right? But you can see here that right in this general vicinity, there are traders trapped right here for sells. There are traders also trapped here for sells. Now you're probably saying, but B, you was selling all here. Hey, very true. But here's the difference. I wasn't selling because of the trend line. I was selling because of, my system, which is EMA respect, push, pull back, blah, blah, blah. I'm not selling for the same reasons that, the masses sell. right? I'm not selling because I see price tap the trend or tap this trend here. My reason for enter, and you would see this in, you know, in the subsequent videos or the previous videos that predate this one, right? I don't enter here. I wouldn't try to enter here because, you know, it just looks good and it have a trend line. I have significantly more reasons, more confluences to enter, right? But nevertheless, there would be traders in here selling who still have their cells open, which is extremely dangerous if you're not trailing your stop loss, which is another thing that I do that masses don't. But there are traders trapped in cells here, trapped in cells here, trapped in cells there, because they're selling every time price hits this trend line. Yes? Yes, do you agree with this or not? The only thing you have to consider now is there a W pattern off of the low at the end or the edge of this trend? And how do you know this? How do you figure this out? You look for the lowest low, right? You're looking for the lowest low within the lowest point within this trend, which would be right here, and you drag a little zone across. And you could actually see it. You could, if we draw it, you could actually see where the dealer, he shoots the market down, he begins to pull it back, and he shoots it back down again. He shoots it back down again. This is now your new lowest point, right? How do you use this, right? In this case, what do you think? We know that if this is a W pattern, if it is indeed a valid W pattern or an effective W pattern, it means that the market should typically go what direction from here? This is now we are looking for, we're trying to discern the direction. Typically, what direction should the market try to go from here? Up, because we know that the traders are trapped in cells here, and they're trapped in cells here, and they're trapped in cells up here. So typically the dealer wants to reverse the market against the sellers. So watch it. We know the direction is up. Very easy to make a move from here. 1 minute time frame. You know what? Let me go back up here. Let's use the replay function. Right? So we're coming back right here, and let's go down on the 1 minute time frame. All we are doing here now, the only thing you are doing here now, because now we know the direction is up, should we be looking for sells or should we be looking for buys? Should be looking for buys. So we look for your bullish ECR, and once you see that bullish ECR, all you're going to do is take action based off of that. Cross of your moving averages, whenever you see that, we take advantage. Boom. Right there, I'm interested in buys. Same 10 pip stop loss. Let's see what happens. Let's see what happens. 10 pip stop loss. Let's just carry that all the way up. Let's see. What do you all think? Do you think we'll be stopped out? Unlikely. Not that it doesn't give me drawdown. It doesn't give me, you know, a little area where the dealer is going to try to get rid of me, right? But this gives me right off the bat here. This gives me automatically about 20 pips. Same 1 to 2 risk reward. It would have given me my 10 pips that I wanted, and it would have literally given me another 10 pips on top of that. Here, let me see, maybe it might have, if you wouldn't have been able to hold it, at least not where you entered here, but I digress. You already capture your 1%. Remember that. You already capture your 1%. That's what you want. You capture your 1%. All right. And if for some reason you wanted to try again, let's just say this is your new lowest point. You say, all right, cool. I want to enter right here now. Same 10 pips. Same 10 pips stop loss. Let's see what happens. Obviously, this you know, you wouldn't try to do this in the same day, but look, you have so many opportunities. Look, another 2% gain here again. So many opportunities to capture that 10 pips. It is like it's I don't want to say impossible, but it's almost impossible for the market to not capture or give you a quick 10%, you know, a quick 10 pips, not 10%, a quick 10 pips real fast. Buys again. Look at how many opportunities you had within the last 12 hours. You had opportunities to make 10 pips here, opportunity to make 10 pips here, opportunities to make 10 pips here. You had 3 separate opportunities to make it 10 pips or a 1%. Just by understanding, obviously, the direction of the market, by doing simple deductive reasoning. Simple, very, very simple deductive reasoning. What y'all think about that? It's literally 10 pips to change your entire life. What do you think about that? It's very safe. It's very efficient. You understand? You're not going to be sitting down looking at your computer for the entire day. You understand? You're not going to be babysitting trades for the entire day. You're literally, all you are going to be doing is trying to discern the direction, what direction you think the market is going to go based on previous information. And then you base an entry on that by using the ECR. That's it. So I hope that this made some sense to you. And I mean, by all means, if it is you have questions, obviously you can message me at Ikata Trading. I'll be glad to help. All right. So yeah. Bilal asks, to see the direction of the market, do you use the time frame you trade on or multiple? Well, I can do this on the 1 minute time frame. All right. I personally can do this on the 1 minute time frame, but I advise going at least on a higher time frame to kind of figure out the direction. You can figure out the direction based on big candlesticks. Big candlesticks are a very good indication that the market is going in that direction. Example or exhibit A. Exhibit A, big candlesticks. Look at the size of these candles. Exhibit B, Exhibit C, Exhibit D, E, F, G, H, I, J, K, L, M, N, O, P. Big candles are a very good indicator that the market is going to go in this direction. What do you think? Yes? So, do we have any questions this morning, guys? 10 pips. That is it. 10 pips. All right. All you need is 10 pips. All right. Obviously, again, me personally, I am known for literally taking a trade with a 10 pip stop loss and holding it for God alone knows how long. I've been known to hold trades for 3 weeks. I've been known to hold trades over the weekend. It's situational, right? But this is a very good entry style, entry technique into gaining experience, but not only gaining experience, still making something of yourself, by trading daily, taking one trade a day, making 1% a day.